it's a testament to what Rob, everyone's built. The group continues to grow. So today, we've got our banking panel. A little bit, I'll start with me and then we'll introduce kind of each of the panelists. Kyle Johnson, I work for Wells Fargo. I lead our middle market commercial banking efforts for Louisiana. Wells Fargo, we're proud to serve as a sponsor for FEG and look forward to continuing to partner with FEG going forward. I also facilitate several chapters across Louisiana and Mississippi. Thrilled to be here today and have these guys join me. We've got great panelists from various sizes of institutions, so I think we'll have a really good discussion. So with that, we'll dive in. Maybe we'll start with Jonathan, a little bit about yourself, B of A.
Jonathan. Hello. Hey, Jonathan Matessino, Market President for Bank of America here in New Orleans and Baton Rouge. I run basically the state of Louisiana for our banking franchise as well as the Merrill Lynch footprint here in the state.
Hamilton.
Hamilton Blanton with Bank Plus. I'm the president of banking. Bank Plus, we're about a $10 billion financial institution headquartered in Jackson, Mississippi. Most of you in this room from Louisiana, we acquired First Bank and Trust about 18 months ago. Prior to that, I was with Capital One for 15 years, running the commercial corporate lending group for Southeast Louisiana. Their structured finance origination team for new market tax credits and our maritime vessel finance business. Been here about 20 years, not a native to New Orleans, born in Manhattan, but it's my adopted home and wouldn't want to be anywhere else.
Fantastic, thanks. Guy.
I'm Guy Williams, Chairman and co-founder of Gulf Coast Bank. We're a $3.5 billion bank. We're headquartered here at Lynn National.
I feel incredibly underdressed next to you guys. Fantastic. Lance Reynolds with Wells Fargo. I run the commercial banking business for Texas and the bordering states. I have been at Wells for 26 years on a variety of different things, and corporate investment banking, commercial banking. I spent a lot of time in energy, so I spent a lot of time in the great state of Louisiana. Really excited to be here. Kyle, just remember we are in mid-year review season, so no singers. Thank you.
All the softballs would go in your way. So let's just start very broadly on the industry side. What are some of the trends you're seeing in commercial banking at this moment? Start with Hamilton.
I'll say broadly, 2024 was a bit of a checkered year for I think a lot of the regional banks who were what I kind of refer to loosely as we're lender for longer. A lot of regional banks have done a very good job of filling up our balance sheet across a broad spectrum of industry and asset classes. But got a little heavy on commercial real estate, where historically construction and firm financing would have had a natural release valve vis-a-vis the CMBS market or non-recourse market. A lot of that slowed down in 2024, but we did see in the back half of last year that market come back, which I think took a lot of on-balance sheet risk and freed up a fair amount of capital, where a lot of regional banks had gotten heavy on the loan-to-deposit ratio. Fast forward to where we are today, I think a lot of regional banks are exceptionally hungry for quality funded assets. I'll say in terms of portfolio mix, I think every regional bank that I speak to is exceptionally hungry for C&I, owner-occupied, real estate, working capital, so non-correlated, non-CRE, IRE-related transactions. So, to a certain degree, our appetite in that space has come back appreciably from where it was 12 months ago. It's a lot more fun being in the market, being aggressive again, trying to make deals happen. I think some of the uncertainty sort of underpinning the election and otherwise has subsided, but that was sort of counterbalanced now by a lot of tariff uncertainty. So it's a mixed conversation. I'm sure we're all dealing with the same things. It's a lot of uncertainty. I'm sorry I missed this morning's conversation, but that seems to be a common theme, is that a lot of folks feel comfortable with tariffs, just they just need to know what it is, the ability to pass it along, and otherwise there is that ability to either share the risk or share some of the cost associated with it. But until we get some certainty there, I think it's going to be an interesting next couple of years.
And Guy, you're similar sized from a financial institution. Is that aligned?
It does. The rapid increase in rates was a little challenging for the regional banks. That's sort of going away. A steeper yield curve makes it easier in the banking business, and I think that's happening. We probably have a couple of Fed interest rate cuts, which would be helpful for regional banks. I think the swung and will continue to go up. There will be a continued risk premium primarily because the deficit is really out of control and neither party has much interest in reducing spending. So it'll take a while before that's solved. We're seeing, people just being a little cautious right now. We finance international trade, we have an international department, and new purchase orders. Until the tariff rules are settled, it's very challenging for our customers to know what to do. So we would urge Congress and the President, whatever they're going to do it and be done, and then people can apply.
Fantastic. And Lance and Jonathan, from a larger bank, money center bank perspective, how's that look?
Yeah, I think it's spot on. I think the market is still aggressive. Both the bank market, the capital markets have started to open back up as well. So I would say just all forms of debt capital are generally available and risk on. No doubt, the uncertainty around tariffs and everything else going on, as the panelists mentioned, there is a bit of uncertainty, so that will slow things a little bit. I think people on the strategic side, we've been involved with a number of discussions that certainly slowed a little bit, just as people try to assess the outcomes and the playing field and how it may impact their business. But by and large, certainly the bank market is still very healthy. We're, I think, still being pretty aggressive on price. Structures are remaining, I think, pretty consistent. The other thing we're seeing, aside from the credit markets, we're just seeing a really big push among our client base, just a really big need for technology and efficiencies as you think about like treasury platforms. How do you manage day-to-day cash flow? How do you manage your working capital? So I feel like a lot of those conversations over the last several years have evolved from I need some accounts, I need a basic structure, to really how do I manage my float? How do I manage my liquidity? How can I improve my working capital management? How do I utilize technology to do that? And then the other big thing within that is just fraud. There's not a day goes by in my business where somebody's not dealing with some level of fraud. So those are, aside from credit, a couple of the other big things we're seeing.
Okay. Jonathan, anything?
No, I would agree. I think on the credit front, you nailed it with risk on. I mean, we're seeing deals, on the larger end, the leverage finance deals, oversubscribed, skinny pricing, which speaks to the demand for assets. And then on the technology side, fraud prevention is, it's every day, like you said. So, as we're looking at technology, we've invested heavily in technology to support that and provide solutions to our clients. It's evolving almost daily.
No, that's good. And look, we touched on uncertainty. It's almost a theme, right? Here with Sarah, last time I checked, we all had shareholders, right? That expect the banks to grow. Like, how do you grow in that type of environment? We'll go, Guy.
Well, we've been fortunate. We're actually gaining market share in all of our markets, and it is a challenge. We reach out, we have personal relationships with people who try to customize the solutions. It has been particularly challenging in Louisiana because until last year, our state was shrinking. The rest of the South is growing, the population was shrinking. It's a lot easier to grow in a growing market. Now, slightly turn that around. We're optimistic and hopeful that will change. We're in Florida, and it's amazing. We have some. I saw the Pensacola folks. People in Florida are just richer than they are in Louisiana. So, it's one of those things that's happening. A lot of people moving in, so those markets are dynamic. It's relatively easy to grow in a growing market. But unfortunately, we've been able to grow in a shrinking market.
Okay. Lance.
Yeah, I think first and foremost, especially in times of uncertainty, we do our best to double down our efforts to stay active in the market, stay in front of our clients. We're daily talking through tariffs and everything else. Just one of the benefits of such a broad platform is we have a ton of content, we have a ton of insight that we're getting a lot of inbound intel that we can help share with our clients. So we're doing our best to stay on our front foot, to stay in front of folks, just sharing insight, sharing ideas, and then obviously trying to support them as they need with liquidity, as they're sort of think through what opportunities they have, because in uncertainty does come opportunity for people once you sort of start to figure out the lay of the land. So making sure that we're providing the right level of capital and advice to help people grow. And then the last thing we're doing is we continue to invest heavily in our team. We too are gaining share across all of my markets. I think dating back to mid-year last year to the end of this year, We will have added over, I think, 31 people just to the sales focus. That doesn't include sort of credit and support. So we're heavily investing in our team. We're growing. We obviously were fortunate enough to bring Kyle over a year ago. We're in the process of building out that team and our presence here. So I think building out that team, investing in our people to make sure that we continue to grow the franchise is a huge priority for me.
And not having to see it.
True.
That helps.
True.
More asset. Jonathan Hamilton, anything?
I mean, I would say for me personally, you know, I sit in a lot of national meetings and we joke, I joke, we cover the entire state, that if you think about, you know, the business community in Louisiana, like the pond doesn't get restocked, unfortunately. I mean, there's only so many venture global projects, so many metadata, I mean, those are huge wins, but we don't have companies moving here. So, you know, our focus has been on really getting to know our clients, digging in, being there for them. I mean, you know, the way I look at it, I'm your advocate, and I go to war for you within the bank to get you whatever you need. You know, at the end of the day, this is a people business, and I'm fortunate to have a CEO and a board of directors that, you know, our mantra is responsible for and client selectivity and really taking the time to be that trusted advisor. And we're, like I said, we're all tasked, we've all got to grow, you just got to do it the right way.
Yeah, and maybe I'll just add, a little unique for us is that, you know, we've grown a tremendous amount in the last 4 years since I've joined the bank. You know, they were about a $3 billion bank. Today we're pushing $10 billion, and we made acquisitions in Louisiana, Alabama, Florida. You know, to Lance's point, I think talent acquisition has been huge in terms of, I think there's an abundance of talent who've all lived through some really challenging years through COVID, which has driven a fundamental shift in the way that, you know, relationships have been managed, how banks interact, and I think it's kind of, you know, everybody in Jackson, the fourth largest bank in Mississippi, everyone views Louisiana, Alabama, and Florida as the land of milk and honey. So for us, in terms of trying to bring over talent with large Rolodexes and the ability to move business, I think is a unique value proposition for us. You know, moving the balance sheet up to $10 billion, we've got clients that have hold levels north of $60 million that I think there's a space, particularly in the, you know, the New Orleans, the Lafayette, the Baton Rouge, the Mobiles, it's a lower middle market business. We don't have that many Fortune 500 companies floating around our states. So I think there's a real space for these regional banks to sort of pick up and take some market share in some of these markets where we hadn't operated this way.
Yeah, no. As you look for growth, right, I think we all see non-banks starting to compete more, both on the credit side, both on the treasury side. What do you see in those non-banks, and can you talk about any maybe partnerships that your institutions are forming with non-banks and fintechs? Jonathan?
Yeah, so where we see them primarily are financial sponsor transactions, where the direct lenders will come in. You know, we may go 3.5 turns of leverage on a deal. You know, they may do 4 or 5, in some cases 6, and they're going to get paid a premium for that. And that's just, you know, that's not where we play. But where we partner with them is on the treasury side, and I've got several clients where we're not the debt provider, but we're the treasury provider. And if it works well, and, you know, and we've got repeat business from that, so that, you know, we're kind of trying to work that angle.
It's interesting. You know, we've seen a lot of, you know, non-traditional lenders creep into this space, and it's sort of had this top-down pressure across the entire board. You know, it's funny. You even see private equity's been, you know, squeezed out of the CMBS space, as you see a lot of insurance money that's taken the investment grade portion of the capital stack and push them into some of the higher risk, higher yield portion of the CMBS market, which has sort of brought that back. You know, on the fintech side, maybe a little differently than in terms of where we compete against them, but, you know, as regional banks, we rely heavily on third-party vendors to help us try to compete with the Wells Fargos and the BofAs of the world. We're never going to be a money center bank, you know, with the ability to do some of the international and other capabilities, but there's a really good sweet spot for where we can rely on fintech technology that the vast majority of the regional banks in the world are all using similar comparable platforms. So whether it's the Bank Pluses, the Gulf Coast of the world, the First Horizons, a lot of the systems we're all buying off the shelf and customizing for our clients, which helps us not be at a competitive disadvantage, whether or not it's $3 billion to, you know, $50 billion. You know, there's a lot of same platforms and technology available to all of our customers.
Guy?
You know, we have a different view on the fintechs. We see them as basically irresponsible lenders. If you look back at the PPP program, almost all the fraud was by the fintechs. And as unregulated lenders, there are no consequences. So if fintechs blow up a certain segment, that's okay, because That was FinTech Fund number 2012. Then you have FinTech Fund 2000. Okay, that one didn't work. We'll start a new fund. So without regulation, they're lending in a way that doesn't make any sense. And it's very challenging if you're trying to do disciplined lending based on cash flow. You know, someone talked about excessive leverage. They have excessive leverage. I think that's one of the weaknesses in the financial system is that a lot of credit has been pushed into this unregulated sector, and when it blows up, there's really no backstop. So we steer clear of fintechs except in terms of technology, but their lending model, I think, is fairly dangerous.
Lance?
Yeah, on the technology front, with respect to fintech, we actually will see them as partners in a lot of instances where we will invest alongside with them to help bring better customized technology to our client base, sort of supplement our product capabilities so we can provide more customized solutions. So we actually will ally with them again on the operations side, your credit points notwithstanding. And then on the credit side, I think we've all seen this growing need for private credit. There's been a growing interest in private credit that sort of fills the gap, north of where traditional commercial banks are comfortable and from a regulatory perspective can go. But something short of high octane institutional or even equity. So we formed a strategic relationship with Centerbridge Partners to form Overland Capital, which is a private capital, performing private capital fund that we've had really great success with for expansion capital, acquisitions, CapEx, and it's been a really unique solution for folks that are comfortable sort of stretching where they may not have normally wanted to stretch with respect to leverage to capitalize on a really cool opportunity. So they're all of those that you mentioned, call it competitive threats among all of our peers, and we got enough of us. So we're trying to find ways to ally and partner to take advantage of them.
Yeah. No, that's great. Look, and the last session was about technology and AI, so maybe we'll move into that a little bit. Everyone has kind of touched on technology. What role do you see technology playing in engaging your clients, and what innovations or investments are your banks most kind of excited about?
Yeah, so there's a couple things that, I'm not a tech guy, I'm a finance guy, so I'm not really smart enough to get too excited about tech, but there's a few technologies that I think, look, the punchline is, I think, at the core of the talk around technology, it's how do we streamline more mundane manual processes and make them more efficient so that our customers can focus on actually strategic decisions and strategic ideas and not have to fiddle with intensive manual processes. So I think that is the root of a lot of our discussions, which went back to one of my opening comments, in that these treasury conversations have evolved, and companies are really looking for advice on truly how do I manage this. And so there's a couple things. We've got an integrated receivables platform that's really exciting, and it takes that sort of manual application of cash to invoice and sort of streamlines and automates it, and the success rate is pretty significant, and so it significantly reduces the sort of the manual time. And then I've just seen a pilot on this technology. I think it's I2I. We're just starting to roll it out, but it's essentially a platform that's a repository. It's a mass database of public and other data, and helps us do industry benchmarking for customers around payable days, receivable days, just a working capital trade. And then it enables us to run simulations real time for our customers. And look, if you just were able to tweak days, a couple here or a couple of there, how significant an impact that can have on cash flow. We can just do real time simulations. And it's kind of an aha moment when people actually see that math. And then you start to think about, all right, how do I make that sort of small tweak, which has a really big impact on capital, which then frees that capital up for other stuff. So those are a couple of things that we're seeing that are saving time and creating more capital for folks.
John?
So if you think about kind of the way we look at AI at Bank of America, if you look at the entire cosmos of B of A client interactions, last year we had 15 billion client interactions across the enterprise. And so we're looking back and we're running analytics on what of those interactions would a human better handle, and what could be outsourced to AI or put on a and again, I'm not a tech guy, I know just enough to be dangerous, but so our entire thought process around AI is trying to designate what would be better served by a human and what we could put on AI to free up our team to go and help clients and help them grow their business and be there for them. And we're really starting to see, just exponential growth in people being able to go online and forecast their cash needs. And like we talked about some of the smart receivable, I mean, it's literally changing weekly. And I mean, we just rolled out a program where, when I'm calling on a company, a lot of the back end, instead of having 2 or 3 analysts put together the industry deck and all these things, we've got, you push a button and then it gets pushed out. Now you still need to tweak it, but you're saving 2 or 3 days of somebody grinding, trying to put all that together. So it's literally changing by the week. So, I think one of your questions was, what does it look like in 5 years? I mean, what does it look like next month?
Yeah,
Yeah.
absolutely.
And, in the larger picture, AI, in some ways scares the hell out of me, but some of the incremental changes along the way are pretty cool. It's freeing up my team to do a lot more with their clients, and freeing up clients, quite frankly, to do a lot more with their businesses, not taking out some of the mundane tasks and those sorts of things.
Yeah, the Hamilton guy. Thoughts?
Yeah, I think we're trying to walk a fine line with how we embrace and leverage AI sort of alongside what I think is a value proposition for us in terms of kind of creating and maintaining personal relationships. I think there's this sort of bifurcation amongst what I'll call commercial and corporate lending and the retail world. I think there's a lot of leverage and benefit for us using AI as it pertains to fraud and credit risk management. I mean, the ability to leverage that in terms of transactions, oversight, and view that we can't do from a manual perspective has really moved the needle in terms of fraud prevention and analysis. Additionally, on the credit side, again, the ability to look through portfolio metrics and slice and dice data that was inconceivable a couple of years ago is now being done at the touch of a fingertip. And then in terms of our retail bank, we've been leveraging ITMs for years at nearly every branch we have across our footprint, and it has allowed us to elongate, service hours for a lot of our retail customers from 6 to 6 or 7 to 7. But on the commercial space, a lot of our folks don't want to call in and talk to a robot or have the chat GPT or somebody else response that they got. It's the red apps. They want to come talk to me, or they want to talk to Angela,
Is that
talk
a
to whoever
technical
else. But I think I can't tell you how many folks that are dealing with frustrations where I won't mention what bank it was, big bank, and nobody's sitting here, but they couldn't do a manual wire. They had to do it online, and they couldn't do their online wire until they'd done a 20-minute tutorial. And this guy's never seen a wire in his life. He's trying to wire me $15 million, and it was a mess. He's like, I don't ever deal with this bank again. So luckily that's not y'all's problem, but it's a real-time example of folks that have gotten to a lot of CFOs, but you don't have to sit through a 20-minute tutorial to move your own money. It makes no sense. So I think we just want to be cautious about how we try to push and force folks to do things through a digital online way that's not beneficial, or the white glove treatment that I know we want to give our customers across our footprint.
Got it.
We have a development group, and we use AI to do about 80% of the coding, and then you have to finish the last 20. So it's really speeded things up, so that's been very important. AI and lending, we could use an AI lending decision model, except the regulators don't allow it, because they want every model to be back tested, and you can't back test a model that's changing literally by the moment. So for consumer lending, it could do better decisioning, but we can't use it there. Commercial, you can. Prospecting, you can use it. So there's a little bit of a regulatory holdup. And then the last part is the customer expectation now is instantaneous. We've all gotten used to going online and doing anything we want instantly. So as bankers, we have to deliver that, but also deliver it in a safe and sound way. And AI does help us get there.
Kyle, can I think Hamilton made a phenomenal point. I think all of us would agree that, big bank, small bank, look, AI is a fantastic tool, it is not a solution. At the end of the day, it also kind of goes, so where's banking going to be in 5 years? Who knows? But I will tell you, the core of what we do is not going to change. Like, this is still a people business. People do business with people they know and trust. People want to interact with people, whether or not you're yelling, if you got the red ass, or you just need some advice, you want to talk to somebody, bots aren't going to do it. People want to do business with people, and that is the core of what banking is. So AI is a phenomenal tool. It can build some great real-time analytics, great data. It can, help streamline stuff. At the end of the day, in our business, this is a people business. big bank, small bank alike, and people will want to do business with people.
Yeah, no, and Guy and I were talking before we came up here just about how AI can play a role in the credit decision-making process. But the reality is character is a piece of that decision-making process. And AI will never know that the balance sheet, the person behind the balance sheet, the person behind the income statement. And the fact is there are plenty of businesses, if you would look at their balance sheets and their income statements, they say, I'm absolutely going to make a loan. But the person behind them may not necessarily be someone that you're going to look to get repaid from, right? So I think that's a key point. It really is a balance at the end of the day between technology being more efficient, as Jonathan said, right? And also balancing that personal touch like Hamilton mentioned. So,
And if I could, not,
Sure, go ahead.
not just on the credit decision, but somebody mentioned fraud prevention, which is a daily problem, and it gets worse by the minute. But AI, we've got analytics that pick up anomalies in transaction data, and they can spit them out. Where it used to take hours, now it's seconds. And it's notifying me, it's notifying the client, and so we're trying to stay one step ahead of the fraudsters, which is a never-ending battle, and people a lot smarter than me figure out those sorts of things. But that's been somewhere we've seen it really, over the last 2-3 years, just it's phenomenal.
yeah. And we've touched on Treasury kind of briefly throughout the conversation. Maybe take a little bit of a deeper dive. What are your clients' biggest challenge from a Treasury management perspective? And what are they asking for today that they maybe weren't asking for 3 years ago? Anyway.
I'll start. A few years ago, you had extremely low rates, so really it didn't matter. So your treasury clients were sort of indifferent. Now they're looking at yield options, which you can earn significant money investing short term. So people are looking at converting receivables into cash, managing their sweep accounts, and maximizing their earnings, and rightfully so, because now you can get a mid-4 fully government guaranteed sweep almost anywhere.
I broken records all be clear. It's fraud and it's efficiencies, right? I mean, those are the big things. There was a Barlow research. I can't remember exactly what, but like the two biggest things corporates were calling out were fraud and fees. So fees are always front and center, obviously. But fraud is clearly a number one, and then liquidity management. It's like, how do I optimize my working capital to free up as much capital as I can? I mean, those are the biggest things that we hear consistently.
Yeah, I would agree. That's all they are.
Yeah. Maybe take a pause. Any questions for the group? You good? We took all of the mics.
Yeah, we have one right there.
We're all that's standing in between y'all and lunch.
Yeah, that's right. Yeah. We'll share. Look at this, competitors sharing.
So, one of the condo association that I know, like they try to, open a bank account, right? And I was telling them that I like certain bank because I can walk in, or I can call, and somebody pick up the phone and resolve it like this. But then as I drove away from the conversation, I realized, wait a minute, that bank was local bank. And I think back about Katrina, right? I didn't have the issue because I was banking with Chase and Capital One at that time, so I didn't have the money issues that a lot of people was having. So I was wondering, have that changed with local banks in New Orleans? Like, if we have another catastrophic incident, can people get their money out of their bank and pay for necessary? I mean, now we have bill pay, and I never use debit card, but I think people do. But I wonder, like as a business, like how hard would it be to get them to do a normal business function banking with a local company?
Yeah, I'll answer that. We're the only one here that's headquartered in New Orleans. Our system didn't go down during Katrina, so people could actually still get their money. We have a big trust department. We manage payroll and retiree. All the retirees got their checks. But we have backup data centers, one in Atlanta, one in Dallas. And these are super secure centers, Microsoft, Amazon are co-tenants. So we have automatic failover to both of those cities. So regardless of what happens to New Orleans, even if we're underwater again, you'll still have access. And of course, since then, we've also added Elon Starlink system, which didn't exist before. So multiple redundant ways to get your money. And not concerned. I mean, we're always very concerned about hurricanes, but we're not concerned that we'll go down. Our call center is in Dallas, just because it just makes more sense for that to be in Dallas.
And on the local front, I mean, I would guess I would ask, as you bank local companies, how important is the branch network to those companies? I mean, are you hearing that kind of companies focus more on electronic payments, right? Or is there still a heavy amount of cash that's kind of coming in for that branch network? Or is it more consumers? How does that branch?
Depends on the company. Most people want to know there's a branch they can go to if they have a problem. But most of their work is done electronically, and cash is becoming less and less of a factor.
Yeah, okay. Go ahead, John.
No, I was just saying, it really is, it's crazy to think back to Katrina and how far technology has come within the industry in 20 years, right? And, things have moved to more digital and, but at the end of the day, to your question about banking centers and, yeah, people still want, at the end of the day, if they need something, and it's more on, I would say, the smaller business and consumer side, but they want to have a brick and mortar they can walk into, sit across from someone and get their problem resolved. So, we don't have them here yet. We're trying to get that done in the next 2-3 years, but it's meaningful.
Yeah, it's unique just because I think a lot of branches are very expensive advertising at this point in the stage of the evolution of banking. That being said, I think a lot of folks don't mind if they drive by one of theirs on the way to work or otherwise. It just gives some sense of a local presence. But in terms of branch traffic and otherwise, I think every bank sitting up here is trying to evaluate what the right coverage model is. And I think you see it all across the state of Mississippi and otherwise where folks try to come. I mean, New Orleans is a great example of that. But sometimes putting an LPO, you gain some traction, especially on the larger commercial and corporate deals. It's easy because the solution set's different, the needs are different. On the lower side of the middle market, business, whether it be cash and payroll checks or getting cash deposits. I mean, cash continues to dwindle as a percentage of the total of what we take. But but we need more branches in certain parts of the city. But it's tough to advocate for, and it's expensive to build. So, Jonathan, I get it. It's a long time. But again, a lot of folks don't mind having one, as they're going to church or going to dinner at night, knowing they're driving by one of your locations.
Yeah. Peyton.
Y'all talk a lot about the ability to sort of increase, just in general, the amount of business you're doing. But a lot of times, we've seen banks unable to do more boutique or tailored work, and private debt, for lack of a better word, has come in. Do you all anticipate the ability to kind of take that share that private debt has taken from the traditional banking world?
I don't know that I would necessarily characterize it as taking back, but kind of my comment earlier, it's one reason why we formed that strategic relationship with Centerbridge to provide private credit, because private credit is here for a reason, and it does fill a need. And we've seen great success with people that want to stretch the boundaries of leverage beyond the bank market. So it is a viable option that people are going to need. So I don't know that I would necessarily view it as trying to take share. I think we are trying to play in that space thoughtfully. And then we're always trying to challenge ourselves. I think maybe to your point where, look, we all have certain constraints that we're just not going to be able from a regulatory perspective to go beyond. But we absolutely, I would say daily, are sort of fighting those fights of how do we stretch the boundaries, because our business, I feel like, just gets more competitive every day. I mean, there's a lot of banks, big and small, that do a lot of the same things, provide a lot of the same capital. Sure, big banks have bigger balance sheet, but local banks tend to have more local presence. So we all fight pretty hard in the sandbox. So I do think we are trying to challenge ourselves, right? How do you get thoughtful? How do you get creative to push some of the edges to get some of that share?
I think the other thing that people forget sometimes is banking is a very thin margin business. We have to make correct decisions 98 out of 9 or 99 out of every 100. So private equity can go to a much higher fail ratio than we can.
They don't have the regulators coming in every quarter either.
Yeah, and I'd just say on the private credit side, I mean, I think where they came in, where we saw them was, filling a void a little bit on the outer side of the risk spectrum where we really traditionally don't play. So I think they filled a gap, and hopefully we're able to be a bridge back to stabilization where a lot of these deals that got underwritten at 3 and 4% with rent escalators and otherwise that didn't contemplate doubling and tripling of insurance expense and otherwise kind of stepped in to bail folks out as they got through stabilization on the real estate side. Now that things have started to settle to a certain degree, and things are panning out, I think that's where the commercial banks come back in to take those things out of that space. But I mean, in terms of going out on the risk spectrum to gain market share, I don't think anybody on the stage is taking that approach in terms of trying to grow our balance sheet. But I will say, I think as we get some certainty, tariffs notwithstanding, I think all of us are willing. I think you're seeing whether it be bilateral, local deals, or just syndications. You're starting to see things still widen out a little bit from a credit perspective. I've seen covenant sets widen out a little bit, structures loosen out incrementally. Risk premiums kind of coming off a little bit. So trying to be selective about where we take incremental exposure, and probably everybody on the side, like doing more with our existing customers. That's the easiest way. When they need more capital, all of us having bigger, well-heeled and performing balance sheets to go step up and do more for them is option number one in terms of how we grow alongside our customers.
Yeah, grow with who you know, right? Ian, back.
Question about fraud. Compared now to, say, 5 years ago, how much are y'all still reimbursing or making clients whole for fraud compared to 5 years ago?
We reimburse it almost 100% typically. Unless there was some extenuating circumstance, if it's on us.
Well, usually this is theft, say remote actors doing business email compromise or what have you. How much are you seeing that
I'm trying
being?
to remember one recently, and again, this is on the commercial side, that we didn't reimburse recently, probably in the last 2-3 years.
Is that kind of universal for everybody?
Yeah, I mean, we work like heck to, wherever it was perpetrated, to see if go back to bank the first deposit or whatever. So there's a ton of work that we will do to actually try to go get the money. And then at the end of the day, you're going to make a relationship call. Look, if you're at fault, that's like the obvious no-brainer. That's not very common. I mean, it is typically the schemes every single one of us has seen either personally or professionally via email or what have you. And then you make the relationship call, and I would agree with that. I don't think it's any different now than it was 5 years ago.
I think the fraud that you have to differentiate fraud. The biggest fraud that's going on right now is the sort of identity where somebody is seeming to be a romantic partner, somebody seeming to be an investor, and they get a person to invest in a fake crypto scheme. And this is hundreds of millions of dollars a day, and people get so wrapped up in it that they voluntarily move their money and then lose it. The generic name is pig butchering, and I was talking to a bank CEO, and he said, I had that happen. One of our older customers came in, and she was so convinced she wanted to take her money out. I told her no. She said, I'm going to call the FDIC, I'm going to call the police. You're stealing my money. I said, no, this is fraud. She was belligerent, getting loud in the lobby, and he finally said, look, I know you have someone else on your account that signs with you. If she will agree, then I'll let you have all this money. And the lady left his office mad. When he got home, his wife said, if you had let my mom take that money out, that wouldn't just be a bank problem, that'd be a personal problem. So people get so wrapped up in these fraud schemes, you can't help it. That is a challenge that we're trying to educate around, but it is very difficult.
And I'll say, obviously, in an instance of bank fraud, we cover 100% of those. And to Lance's point, it's all relationship driven. It's case by case basis. I mean, there are a lot of instances where you've seen cyber attacks where folks hack into folks' online banking platforms, have the ability to make and change wiring instructions. And when a wire gets sent, there's not a whole lot one of us can do when those dollars go out. I'm sure everyone in this room has either seen it firsthand or heard secondhand about horror stories online. We're talking about millions of dollars that go lost and go international otherwise. So, I mean, a lot of this is incumbent upon us as bankers to educate our clients on best practices, tool controls, and otherwise. Because look, all of our interests align in making sure that your money stays with you and doesn't go to folks it doesn't need to. And they're smart, and it's we've all been in banking a long time. The evolution of fraud and how folks go about trying to perpetrate it is evolved a lot over the last number of years. So it's paramount for all of us here, and I think that's why a lot of the processes you've seen, whether it be banks of our size or big banks, in terms of trying to create requirements on our customers to have processes in control to make sure that a lot of the easy movement of money electronically goes through multiple layers of approval and platform and additional eyes is really important.
But just to add to that, I mean, do you just write off a percentage like a bad debt or like a shrinkage at a grocery store? Is it just, I know y'all have to eat that, and that's got to be the numbers got to be going up. It's got to get to a point where like, we no longer can just keep eating this. But then again, on the other side, is AI or technologies that should be helping you to stop it, kind of like what you just said.
I would tell you, I think again, Hamilton's 2 for 2, that's another great point. Honestly, it's us getting ahead of it as humans much more than AI. The AI will find some of this slicker stuff from a tech perspective, but to be honest with you, it's educating your teams on just the very basic blocking and tackling of what to do and more importantly, what not to do. Voice confirm, dual control. Like there's so many basic things we can do as humans to prevent a lot of this. And so that's where we are certainly very focused, clearly still utilizing AI for some of the slicker stuff. I don't know that we're just flippantly writing stuff off. Like Hamilton again is right, it is going to be a case by case basis. By and large, the general bias is going to be to reimburse. But we will find times where there is stuff going on inside of a company where they've got bad insiders that are doing stuff, and so those are different situations. So there's just not a universal answer to this question. It's a real issue for us. It's a huge issue for you. We are all trying to minimize it. The education and how we handle our day-to-day business as humans is the single most important thing we can do to offset it.
I think the other challenge is we're now facing not just individual fraudsters, but national actors. North Korea, Russia, fraud as a business, hacking into company systems.
Yeah, and that's why you see such an emphasis on dual control, right? You guys know your companies better than we do, and you always will. And so that's why you see banks pushing the decision making to you, not calling up the bank and saying, hey, I want to do this. So and it's just the liability, it's just the responsibility, to people who know their companies best. So. Questions? I'll open it up to you guys. Anything you want to leave us with today? A really good quip, advice.
Talk to your team about fraud if you haven't taken anything out of this. We all genuinely appreciate the opportunity to be here. This is a hugely important market for us. There's a lot of uncertainty out there like we talked about, but there's a lot of opportunity out there. And we continue to invest, like I said, in our team and in technology to continue to evolve with the market and really trying to double down our efforts on the advisory front, like I've talked about. Not just because we talked a lot about TM here, but you also have half of U.S. businesses are owned by people 55 years and older. So there's a pretty massive transition afoot amongst businesses, be it hand it down to the next generation, sell it, find other investors. So there's just a lot of fun stuff going on in the market with the backdrop of all the uncertainty we're all dealing with, but that's what we're here for. To me, that's the exciting. It's status quo is boring. And God knows in my 26 years, I've seen a pandemic, we've seen 9/11, we've seen the financial crisis. It's like the hits keep coming. But you manage through, and you do that by talking to each other and keeping each other informed and making sure that we're listening. And that human interaction is just never going away. It's the best part of this business. So thank you all for having us.
I think people can get pessimistic, but they forget the U.S. is still the most dynamic economy in the world. People still want to come here. China and Russia are big natural opponents right now, but people are not trying to immigrate to China and Russia. So great opportunity here. We have elections every 2 or 4 years. If you don't like the incumbents, you get a chance to vote them out. Most people in the rest of the world wish they had that opportunity.
Maybe one thing I have to say is, everybody that on this panel is going to say that we have relationships with our customers. Over communicate. Look, we know there's so much uncertainty right now. The more we know on the front end, we're all partners with you. We want to work with you. We know there's going to be some challenging times ahead of us, or it could just be things that you need in advance. The more that we know on the front end, the easier it is for us to plan, adjust, help advise, structure, and otherwise for the benefit of our customers and clients. So don't view us as adversaries. Don't view us as someone who's not going to try to work with you. Nobody in this room wants to own your business. I promise you that. That's the last thing we want. We want to help you grow. We want to help you expand. We want to help you manage through tough times, because we're all going to experience this. So don't feel like you can't share some early crack in something that you see forthcoming, because we all know none of us in this room's got a crystal ball. We just know we want to help everybody, across this region. So view us all as partners, sincerely.
John, final
Yeah,
word?
no, great points, all three of you. Hamilton stole my thunder on communication.
He's on a roll today.
I know, you make my job easy.
Yeah.
So, no, look, thanks for being here. Great room. Feel like it was a good discussion. Please, speak for me, and I'm sure everybody else. Feel free to reach out to us. Questions, concerns, use us as a resource.
Yeah. The bankers aren't leaving anywhere. We got happy hour. We'll be here all day. So thank you guys very much. Thanks to the panelists. Really appreciate your time and calling out.